A very good morning for all the valuers here. We are all here today for this wonderful session on valuation of securities under Companies Act, interplay with income tax and FEMA. Mr. Chandrasekhar is our own active BVA member. So we are all happy to encourage our own members to be the speakers for every session. And one more important announcement I would like to make here. Vijaya, allow me to share the screen.
Yes, ma'am.
Bangalore Valuer Association, partnering with IIV India Registered Valuer Foundation, is organizing a two-day session, 15th and 16th December 2023 in Bangalore. We are yet to finalize on the speakers. The flyer will be issued shortly to all the BVA members. This is for the information of all here, and please share all of this information with your friends. Kusum? I request Kusum to introduce today's speaker, Mr. Chandrasekhar.
Thank you very much, Shilpa, and very good morning to all the participants. I want to start this morning with a quote. The world hates change, yet it is the only thing that has brought progress. So while change can be very challenging to manage, it's often necessary for the survival and advancement in any sphere. Accepting change with a positive attitude can help one adapt to the dynamic circumstances with less stress and emerge victoriously. So as we are all aware, the issue of transfer of equity shares or other securities, it invariably involves the valuation of the underlying company. The principles and rules for valuing companies lie at the intersection of law and accounting. There are various statutes and regulators who are involved in this crucial activity. The company law, it actually seeks to ensure that companies do not shortchange their existing shareholders by issuing shares at a below fair market value. The Reserve Bank of India has also come up with a number of notifications, circulars, regulations to regulate the inflow as well as the outflow of foreign exchange, more particularly when it comes to non-residents, when they are underpaying for the Indian securities or selling the Indian securities to the Indian investors at a higher value than the applicable fair market value. The income tax authorities too have an interest in ensuring fair valuation of the securities that are issued or bought and sold only to prevent tax evasion. We have this morning with us our own CSK Chandrasekhar, who will be delving into this myriad laws, rules, and regulations that are at interplay in relation to the valuation of companies. CS Chandrasekhar, he is a postgraduate in commerce from Osmania University, Hyderabad. He is a company secretary. He is a cost accountant. He is a law graduate. He is a semi-qualified CA and a qualified statutory auditor. He is also a qualified insolvency professional and a registered valuer. He has over 2 decades of corporate exposure, and he has worked with Indian companies as well as MNCs. He has worked with listed, unlisted, as well as closely held companies. He has vast experience in secretarial matters, legal matters, corporate governance, finance, accounts, audit, taxation, commercial laws, insolvency matters, and of course, business valuation. He has started his own consultancy firm, KC Shekhar and Associates Company Secretaries, which offer secretarial corporate advisory, valuation, as well as LP services. He has worked with various companies, including a Japanese company, Denso Kirloskar Industries Private Limited. He's also an avid speaker. He has presented in various seminars and study circle meetings at ICAI, ICSI, CMA Institute, as well as Institute of Public Enterprises. And he has also spoken under various matters, including transfer pricing, as well as income tax. He has successfully completed GST migration activity of ACE Micromatic Group and convergence into Ind AS. So we have a very experienced speaker. I know Mr. Chandrasekhar personally. He has been a great help, whenever anybody approaches him with, any favors. So I welcome him this morning and ask him to, take over the session and impart and enrich all of us. Thank you.
Thank you, Kushum. Very nice and detailed introduction. And thank BBA for giving this opportunity. Very warm welcome for all the participants on this. Shilpa, am I audible?
Yes, you are.
Warm welcome for all the participants. Just to start with this nice introduction morning, this valuation of securities under the Income Tax Companies Act interplay with the Income Tax and FEMA. We thought as a valuer, she is introduced nicely. Changes are inevitable and we need to cope up. India now, a lot of changes are happening. India, further issue of shares, the transfer of shares, transmission. And we are only dealing with the valuation. But we wanted to see from other side, Companies Act side, income tax, FEMA, who has to do, though valuer, we are required to do valuation and IBB registered value for certain matters, but we need to know what is the other side. So with this, so we thought we wanted to just connect how valuation is required under the Companies Act, how it connects with other other laws, and also who has to issue, what are the methods. Vijay, can I share my screen?
Yes, sir. Please, sir.
Valuation of securities under the Companies Act, interplay with the income tax, FEMA and IBC. What we thought is, before going to the main topic, and also it has taken a significant importance with the amended recently Rule 11 UA on 25th September. So what I am planning to do is I am just going to connect what are the various requirements of valuations. So who has to issue, what the method. Just to start with that, I would like to say requirements of valuations. Under what are the various segments, what are the requirements, who can issue the valuation report, whether IBB registered valuer can issue, whether chartered accountant can issue, whether cost accountants can issue in practice, or merchant banker. What are the various scenarios under which Companies Act we require valuation report? Under SEBI regulations requirement, FEMA requirements of valuation, under IBC. And the main topic of the is under Income Tax Act. Next comes to the how to determine the fair market value. We call fair market value, we call fair value, and the different concepts. So how to define arrive the fair market value. Recent amendments to valuation rules on 25th September 2013. And what are the tax? Are there any tax implications to the shareholders in case of rights issue or preferential allotment? Then transfer, gift of equity shares. Transfer of shares under different scenarios. So just to start with that, we have a valuation requirements under the regulatory requirements. Regulatory requirements start with under Companies Act rules and regulations. SEBI regulations requires valuation report. Income tax requires valuation report. Under FEMA requires valuation report. IBC. So these are all statutory requirements where corporates need to submit the valuation report. And different purpose, different person can issue, we have to issue different methods. Coming to financial reporting, whenever this amalgamation, merger, demerger happens, for purchase price allocation and also for issue of shares under M&A, it is required. Portfolio investments, fair value reporting under Ind AS, impairment testing. Deal related, mergers and acquisitions, mutual settlements. Next comes other settlement, family. So these are the requirements of various scenarios. One will be looking for valuation reports. Next comes to the topic, who can issue? So valuation report under Companies Act, only an IBB registered valuer can issue. Under SEBI regulations, some cases registered valuers can issue, predominantly merchant bankers, and a few cases it goes with the listed statutory auditors because it is a listed shares are frequently traded. Under Income Tax Act, rules, income tax predominantly deals with the chartered accountants and merchant bankers valuation report. On some cases, even management can issue valuation report for some purposes. Under FEMA, CA, merchant bankers, cost accountant. IBC, under IBC regulations, only IBC registered valuer can issue. Under Ind AS, it is clarified by Institute of Chartered Accountants of India saying that IBC registered valuers can issue the report. So these are the various enactments. These are the people can issue the valuation reports. Next, coming to the under the Companies Act, just before going to the main topic, I wanted to just connect our professional opportunities. What are the cases where we have opportunities so that we can, whenever we discuss with the client, we can explore our opportunities. Under the Companies Act, we have further issue of shares. Whenever we go for further issue of shares, that is our main purpose under Section 621C valuation report. Under Section 192, whenever company is having a non-cash transaction with the directors and related parties, with the valuation report. And scheme of corporate debt restructuring 230, Section 230, subsequent 2, subsequent C, there is a requirement. It is a merger and amalgamation. Merger of a listed company with unlisted company and shareholders of listed company in case if they decides to opt out for the under Section 232(3). Whenever purchase of minority shareholding by the acquirer who is acquired already 90%, there is a requirement in winding up return of allotment. So these are the some of the instances where valuation report is will be required in the corporates. So predominantly we will be looking only for under the issue of shares, but apart from issue of shares, we got a lot of opportunities where there is a valuation report required. Sometimes corporates may not be aware. So knowing this and also exploring opportunities with the corporates will a lot of benefits. Even client also will appreciate, saying that when they call for some discussion, if we explore these options, then client will appreciate. Also, apart from this, under SEBI regulations, we got many requirement. Under SEBI ICTA regulation, there is a requirement. SEBI appointment of administrator and procedure, SEBI real estate investment regulations, SEBI sweat equity shares. So these are the requirements under SEBI. Next, coming to the FEMA, that is another area where predominantly now India is a global destination. We are getting a lot of FDIs and also ODS. India is also investing. And whenever we talk about issue of shares or investment in outside India, then when we approach our authorized dealer, AD banker, then we get into the question of valuation. Whenever companies FDI coming into India, if we are issuing shares to the subscribers to the memorandum of association, there is a valuation report, is a valuation requirement. But since this is a subscribers to MOA and we'll be issuing that face value, valuation report not required because it is the first time company is getting incorporated. When shares are being issued at face value, no valuation report. If companies are issuing further issue of shares, in case of listed companies, SEBI guidelines are applicable. In case of unlisted companies, and we have to go to the valuation report either from a chartered accountant or a merchant banker. Here, IBB registered valuer as of now, FEMA is not recognized presently. Coming to the pricing, one will get doubt what is the pricing. Whenever we were getting an inflow into India, then the price, issue price or transaction price should be more than or equivalent to the valuation. So when we are getting money, then it should be more than or equivalent. Similarly, transfer of shares from a resident to non-resident. Whenever resident is transferring shares to a non-resident, if it is a listed company, pricing has to be as per SEBI guideline. If it is an unlisted company, again, same principle like issue of shares. The transaction value should be more than or equal to the guide, value, fair, whatever you are in the arm's length price. Under FEMA, it is called as an arm's length price. Under income tax, fair market value. Under the IBB regulation, we call it as a fair value. Similarly, If a resident is acquiring a share from a non-resident, again, the valuation report is required. Here, I can't pay more than what is the arm's length price. So this is a snapshot of FEMA requirements and valuation requirements. What is the transaction price? Transaction price has to be more than the valuation or it is less. So thumb rule is very clear. When money is coming into India, we accept more. It should be more than equal to the arm's length price. When money is going outside India, when we are paying, so we wanted to pay less dollars. So it should be less than or equivalent to this one. So this is a just to before going to my main discussion, I would like to just connect these points. What are the requirements? What are the principles? In case of under FEMA, always valuation is the arm's length price with the international accepted the international valuation standards. Same principles are applicable for issue of shares as well as transfer of shares as per the FDA and ODA guidelines. Next, coming to the valuation under IBC, Insolvency and Bankruptcy Code, there are multiple scenarios under IBC where whenever companies are going for voluntary liquidation under Section 59, corporate persons, if they got any SFA, securities or financial assets, they need to get a valuation report on the fair value. Similarly, under Section 46, subsection 2, they need to have an independent expert to assess the evidence of avoidable transaction whenever we go for preferred transaction, preferential avoidance and also fraud transaction. And IRP, in the main CRP cases, in all CRP cases, IRP has to open 2 registered valuers for valuing the SFA. From that, you will be taking the valuation and average. In the liquidation, so again, he has to go for valuation. So this is a snapshot of IBC. Under IBC, whenever company is going for a company is in a CRP, there is a valuation requirement. Whenever again once it moves to liquidation, there is a valuation requirement, valuation, under also voluntary liquidation. So here under IBC, that we have got a fair value as well as liquidation value. Unlike under the Income Tax Act of fair market value, here we have 2. So it depends upon the purpose of the is it going concern or liquidation. We need to use the fair value or liquidation value. Coming to the main core topic about Income Tax Act, that's what we are would like to plan. We are planning for a detailed interaction. Valuation of the Income Tax Act. Just to give a background, there are 3 sections or mainly 3 sections are there. Section 56, subsection 2, class 7B. This is angel tax. Whenever companies are issuing shares, then 56(2)(7)(b) is applicable. What it says is, when a company not being a company in which public are substantially interested, it means that this is not applicable for listed companies. This is applicable only for unlisted companies, and also they define a public in which company in which public are not substantially interested. From any person for any consideration for issue of shares that exceeds the face value. So 56(2)(7)(b) talks when an unlisted company, closely held company, issues a share for any consideration exceeding fair market value. So the question comes into picture, we start fair market value. We'll discuss just about what is fair market value. And in case if it exceeds the fair market value, exceeding the face value. So even the fair market issue price exceeds the fair market value, but if it is less than the face value or equal to, then there is not a treated as an that is not an required to pay. There is no requirement to offer for the tax. And provided this clause shall not apply for by a venture capital company from a venture capital company or venture capital fund or specified fund by a company from a class of companies. So there are 2 exemptions are there under Section 56(2)(7)(b). One is for venture capital companies. Second thing is such class of companies notified. These class of companies notified are startups. So this is a one we'll be discussing exactly under what circumstances 56(2)(7)(b) is applicable. Next question comes, this is a transfer of shares. Whenever transfer of shares happens between the 2 shareholders, though company is not involved, seller and buyer involved in the transaction. For a seller, 50 CA is applicable, notional capital index, in case if the shares are sold at below the fair market value. What it says, where consideration received or on acquiring and transfer capital asset, being unquoted share is less than the fair market value, the fair market value should be deemed to be the full value of consideration. So here, whenever unlisted companies shares or deals are happening, they need to ensure that price should be minimum fair market value. If it is less than the fair market value, the differential amount is treated as a notional capital gain tax in the hands of seller. Similarly, 56 to 10, this is a predominantly, it is called as gift tax. What it says, if any person gets any benefit, the benefit needs to be offered to the income tax. What it says, when any person receives any property other than immovable property is covered under a different class. So for us, the securities on the financial assets, this is a 56 to 10 is applicable. When a person receives any property other than immovable property without consideration. So in case if they get without any consideration, the aggregate fair market value which exceeds 50,000 rupees. It means that any person gets benefit from other person is a taxable subject to the 50,000 rupees. So if the benefit is getting with 50,000 or less than that, it is not taxable. Or for consideration which is less than the aggregate fair market value. So this 56 to 10, it is regularly it is applicable for all income transactions. So we are discussing now with reference to our shares. Any property, if any person gets any property without consideration or with inadequate consideration, the differential between the fair market value and also what is consideration that needs to be offered by the person who is receiving the benefit. Just to see, we discussed about 5627B. 5627B is applicable for the company when they issues. What it says, company not being a company in which public or substantial interested receives in any previous year. For many person not being a resident, the not being a resident is removed now from 1st April 2023. So from any person. So earlier, this clause was not applicable for offering of shares to FDIs. Now it is applicable. Consideration for issue of shares that exceeds fair value. This does not applicable again venture capital company and also for a specified companies. Just to see what is the company in which public or not substantially interested. Not being company public or substantially interested means company not being a company in which the public or substantially interested means companies owned by Reserve Bank of India or government companies or government holds not less than 50% of the shares held by the bank. For Section 8 companies, mutual benefit companies and Nidhi companies, where 50% of the shareholders are cooperative societies and listed companies. So when it comes to your first one, company not being company in which public or substantially interested, predominantly covers about unlisted public companies and private limited companies. So whenever these companies offer the shares under Section 5627B, it can be rights issue or it can be preferential allotment that we will discuss exactly. This clause gets triggered from any person. This any person includes all persons including NRIs and OCB. Earlier, it was NRIs were not covered and OCB for FDI, now it is covered. Next, consideration. This can be cash or consideration other than the cash. Issue of shares, including preference shares. I think most of the times we think that only equity shares. Even this 5627B applies equally for a preference shares also, but not debt instruments, because the word says issue of shares. Shares includes equity and preference shares that exceeds the fair value of such shares. Just to make little clarity, all companies, whenever they go for a private, whenever they go for issue, the issues can be rights issue or bonus issue. Or private placement or preferential allotment. companies can go for rights issue, or bonus issue, or private placement, or preferential allotment. Under these allotments, then 56(2)(7)(b), one need to take care from the point of view of income tax. Sometimes what happens, same transaction requires valuation report of the Companies Act from the IBB registered valuer, and the same valuation report requires valuation either from the merchant banker under section 56(2)(7)(b), or from an IBB registered valuer if it is NAV. So while giving the evaluation report, as a IBB registered valuer, we need to inform the client saying that what is the requirement as per the Income Tax Act. We have come across some of the situations, we will not inform about the requirements of income tax. We will say that just I will issue the report for issue of shares, we will close it. So client will come to know after 3 years when the assessment comes. Sir, the valuation report, this is not acceptable. Then that time, it doesn't look nice saying that my report holds good only for issue of shares under the Companies Act. For Income Tax Act, you need to get a merchant banker. So as an to have a strong client relationship, it is our duty to inform to the client whatever I'm giving a report, it serves the purpose of only for under the Companies Act for the same transaction. If it is under income tax, or if it for issue of shares to FDI, it requires one or two more reports. So otherwise, client will not appreciate, and also client see being professionals, this is our duty to make him clear about the transaction. Now we discussed about the 56(2)(7)(b), fair market value, issue price, face value. Just to make little more clarity for the benefit of our understanding, I have taken one illustration. ABC Private Limited issues shares of face value of ₹100. So ABC Private Limited proposes to issue shares at ₹100. Now the situation is like this. Fair market value is ₹100. So fair market value as per Income Tax Act, they have calculated is ₹100. Issue price is 80. So are there any challenges? So I would prefer some other people just either say mute, unmute, or you can respond, otherwise you can send them the chat. So chat box. So if a fair market value of share is ₹120, if issue price is ₹80, issue price is ₹80, are there any challenges? So we'll say no issues. Hashtag mark is there. If a fair market value is 120, issue price is 100. So now we are issuing shares at ₹100 less than the fair market value. So does it attract 56(2)(7)(b), whether we have to pay any additional tax? Members just they can say respond. No issues. If a fair market value is 120, issue price is 120, no issues. If a fair market value is 120, issue price is ₹150. So are there any complexity from the Income Tax Act? Anybody just can respond? Added to the income tax. Income. What is income now in this case? Differential amount. Members can just respond in case if they want to just share.
Actually, people are responding in the chat also.
Okay. Yes. So I got something, and I think it is an 150, ₹30 until prior to 25th September, ₹30, but now it's not 30. It is ₹18. So ₹30 was right to some extent. Now because of a new amended rules, they're given a 10% safe harbor rule that we'll be discussing later. So this is a snapshot of an 56(2)(7)(b). We mentioned here note 1. When a fair market.
So I have one query.
Yeah.
So apologies, I have one query. where the issue price, if the face value is 100 and the issue price is 80, won't you have a challenge under income tax where it is for insufficient consideration?
Yes, it is there. Actually, I mentioned no issues, but again, there is a asterisk mark is there. Here, there are two conditions. Companies Act does not permit it. When the face value is 100, then they can't issue shares at 80 rupees. So, though we are talking only for a hypothetical situation for IT purpose. So, issue price less than 100 not permitted. It has to be only 100. Point number one. Point number two
Oh,
is...
sorry, sir. I didn't notice the asterisk. Sorry about that.
Okay, so that's one. Similarly, if 120 rupees is a fair market value, if issue price is 100 rupees, though it is 100 rupees, but issues, because what's happening is issuing shares at the less than the fair market value. So the company is not covered, but the shareholder may be covered under 56 to 10 because 120 worth share is getting 100 rupees. So there is a possibility that buyer, not the company, buyer may be asked to pay the tax. However, there are some conditions are there. We'll discuss in the next slide. Continuing this, I slightly made a different same ABC Private Limited. ABC Private Limited issues shares of face value. So in this case, fair value FME has become 80 instead of 120. Issue price is also 80. No issues. So under income tax is no issues. Again, there is asterisk mark. Companies Act is not permitted. Now, if fair market value is 80, issue price is 100. So does it now? This is an now. Fair market value is 80, but we are issuing at 100 rupees. Face value is also 100 rupees. Pardon?
No issue.
Why? Because we are issuing more than FME, no?
Is equal to face value.
Yes, sir. So no issues, sir. Now, fair market value is 80, which is 120 rupees. So what are the taxable, sir, in this case? 20 rupees is taxable. Similarly, if 80 rupees, if it is 150 rupees, 50 rupees is a taxable. So in this case, yeah. So this is about 5627B. But this, again, the safe harbor rule is there now. 80 rupees will become 80. 10 rupees condition is there. We will go to the next one. So at this point of time, it's very important to know that shares can, and if the such issues are, if it is at face value, even though more than the fair market value, no problem. If the shares are issued at a premium, we need to see whether such premium is less than the fair market value, no problem. If such premium is more than fair market value, then problem with Income Tax Act. Similarly, shares, if it is issued discount, though income tax has no issues, but the Companies Act is a problem. So this is a summary of 5627B for various issues, and also its applicability. Now, also under in case of 56.210, in case of gift tax, any benefit received up to 50,000 rupees is considered as an exemption. But in case of 56.27B, which talks about angel tax, any benefit, so the 50,000 rupees is not applicable. Even in case number of shares issued multiplied by issue price minus fair market value per share, even if the above value is less than 50,000, it shall be added income from other sources which has issued shares. So in case of 56.2, so this is about all about 56.27B. Any at this point of time, so if any points are there on this issue of shares, fair market value, we can take one or two questions, sir. Now, we discussed this 56.27B, we discussed about issue. The next talks about transfer of shares, sir. How to determine the fair market value? I think we are discussing about FME. What is FME? We'll discuss now. See, fair market value we have on income tax with reference to the two. under two transactions. One is transfer of shares covered under 50 CA and 56(2)(10), read with Rule 11 UA subsection 1. Rule 11 U talks about, to understand where terms used under Rule 11 UA. 11 UA 1 CA. Under Rule 11 UA 1 CA talks about valuation principles of quoted securities. Rule 11 UA 1 CB talks about principles of unquoted equity shares. So, all transfer of shares covered under Rule 11 UA subsection 1. C. In that, A is listed shares, B is unquoted equity shares, C is preference shares and other securities. So, this is about fair market value under the Income Tax Act covered for transfer of shares. Two sections 50CA and 56(2)(10) covered under Rule 11 UA. Listed companies, quoted securities, unquoted equity shares, we will be discussing about the firm procedure, and unquoted preferential securities. Now, we discussed about the issue, transfer of shares. Same issue is there, fair market value for issue of shares. For issue of shares, 56 applicable section is 56(2)(7)B, reduce Rule 11 UA 2. So 11 UA 1 is for transfer of shares, 11 UA 2 is for issue of shares, the principles. What it says here, Rule 11 UA 2A, valuation principles of unquoted share, equity shares, issue of shares, 5 methods. With effect from earlier, we had only 2 methods. Now there are 5 methods effective from 25th September. There is an amendment to Rule 11 UA. Other matters. So after the amendment, we got, earlier also we had a confusion. Same issue of shares, Companies Act, FEMA, Income Tax Act, Rule 11 UA, 11 UA 1 and 11 UA 2. Added to that, merchant bank, when can issue merchant banker, when CA can issue, when an accountant can issue, when management can issue. Added to that, what method? NAV method, net adjusted book value method, and DCF method. So added to that, they have also added some more confusion now, rule by introducing the new amended Rule 11 UA 2A, where it says for issue of shares, this 11 UA 2, which is amended effective from September 25th, it is applicable only for issue of shares. So here they have given 5 methods. Earlier we had 2 methods. One is a CA and also merchant banker. Now they have given 5 methods. Rule 11 UA 2B talks about valuation principles of convertible, compulsory convertible preference shares. Rule 11 UA 3 talks about validity period of a merchant banker report. So this is a very important section. Wherever it is, where we talks about Income Tax Act, we talks about if it is a transfer, 11 UA 2, no changes, simple process, net adjusted book value. 11 UA 2 issue of shares, covered under Rule 11 UA 2. There are methods, persons also they defined. Which method? Who can issue? So merchant banker can issue only DCF method, other method. CA can issue only for the NAV method. Going by that, variation is also permitted. Now the important thing is they also mentioned a Rule 11 UA 4, because exactly value may not be is very difficult to get it. Variation is permitted 10%. So if the valuation report fair market value 100 rupees, issue price can go up to 110 rupees. So safe harbor rule they introduced up to 10%. Now, in order just a little more clarify for securities for transfer of purpose, we already discussed now in the previous slide. In case of listed companies, it goes with the 11 UA CA. You take. In case of unlisted companies, it is separate. Listed companies, if it is a transaction is happening through market. If I'm buying unlisted listed company securities through market, whatever the purchase transaction price is in a fair market value. If I'm buying listed company shares but off market, then I need to see what the trade price in the market. So, for in case of securities, either equity, preference, or debt. In case of listed securities, transactions happening through the market, transaction price. If off market, list traded price in the market on the relevant date, on the latest date. Now coming to unlisted securities. In the unlisted securities, we have equity covered under Rule 11 UA CB. Other securities. Here, other securities covered preference shares and debt securities. If it is equity, that is our discussion. It is an NAV method. Other securities, estimated price which you fetch in the open market. So this is all about securities covered for transfer of securities, not for issue. So listed companies. Continuing with that, any points here for discussion? Is that I think clear now? What are the? I wanted to just give set the platform saying that where exactly requirement is there. So requirement is coming here in NAV method. So in order to arrive this, I wanted to give background. These are all secure listed companies not applicable, unlisted equity NAV method, unlisted other securities. We are going with the estimated price. So continue with that 11 UA under this unlisted equity shares.
No, so the for other securities, estimated price means TCF only. Yeah?
Sir, actually it depends upon the appropriate method. If it is in preference
Okay.
share, we'll go with the discounting and these other factors. Depends upon the nature of security, sir.
Okay, that means supposing there are debentures,
Yes, sir.
transfer is happening between one debenture holder to another debenture holder.
Yes, sir.
So then we need to do a discounting cash flow and also see NAV, because whether the company should have basically assets, no, so much to repay.
Exactly, sir.
So you have to discuss all the three methods, and then
Arrive to the what is the
what the best estimate price.
sir, but here in case of here
Equity is clear. Equity is clear, right? Equity is
sir.
clear.
Here is not clear, so depends upon the nature of security. Whether is it in preference shares, is it what is the coupon price, what is the I think as you said, we need to discount DCF method also needs to be considered, sir.
In the market price, suppose this is 7% debenture, but
Yes,
in
sir.
the market you have 10% debentures. Then
Exactly.
also like that.
Absolutely. Thank you. Yes, sir.
Okay.
Okay. So this is about
Sir, I have one query. With regard to the methods that's been notified under the new regulations, has anybody done any of those? Have you come across any of using any of those methods, sir?
no, as of now, just it is only how much today is 14th. 24 days is old. I have not come across, but the discussion is going on. We'll come to that. We'll discuss what is the method. There predominantly, I think, not started in the market. I'll come to the next slide, madam.
No, but one more thing, Chandrasekhar. Actually, entire this thing is an optional thing, no?
Yes,
See,
sir.
most of the people may not even do any valuation also under income tax. They can simply do whatever transaction they want, and then when the demand comes, they can pay. It's not like a Companies Act where without supporting document,
Where
you can't do transaction.
Correct. Companies Act, you will issue the show cause notice immediately if there is no report. But income tax will talks about only when the assessment comes. Sir, but having said, if the assessment now it is easy to make it out. Otherwise, when the income tax assessment comes, it will be the burden will be more, no, sir?
Sir, which balance sheet to take into cognizance for transaction purposes? Because let's say I have 31st of March 2023 audited balance sheet with me, and I'm doing the valuation as on date, which is say 7 months old balance sheet. Which balance sheet to opt for?
Okay, I think you were asked. I understood that you have 31st March 2023 balance sheet. Now the transaction is happening in the month of say January. So which balance sheet to be considered? Is that the question? Am I right, sir?
Yes, sir.
So other members, senior members like Ravi Shankar sir, they can just add me. Sir, in our case, what we do, assuming that the same, I have one assignment now where transfer of shares has happened in the 5th March. So we have got a latest audited FS of 31st March 2023. We requested to get the at least December financials, if not on 5th March. Then they said not possible. So what we are doing in your case, we are taking they got a luckily 30 September financial. So 6 months whatever they got profit, proportionately we are taken for up to 5th March based on number of months. So and our assumption what we are making the report is management confirmed that there is no significant change in the business scenario. Whatever there for first 6 months, it continued. So they got some profit for 6 months. Same profit we are calculating, adding back to the profit to the what we are right. We are giving the report now. But some people, yes, sir.
That's great, sir. But let's say for 30th September as well, should we ask for the audited balance sheet or provisional will suffice? Provisional certified by the management under MR.
Absolutely, sir. Audited is the requirement. Provision will suffice. What happens now? As long as the management confirms that the principles and also the whatever they followed earlier, they followed, I think provision also suffice, sir. But if they can get the audited, is a good. But most of the cases, they will not get the audited financials. The management certified financials, we are going ahead and we are doing. And what happens? This is what we're talking about as in the date of transaction. When you go for assessment, it will be 3 years or 2 years old. By that time, you will have audited of financials. So difference between provisional financials, what is considered based on the, as I said, for 6 months or 9 months. Actually, if there isn't differences, then likely that there will be additional demand. So based on that, if the management makes a best estimate, I think provisionals should hold good.
Another Chandrasekhar, one more thing in this case is that
yes, sir.
This is a transaction between two shareholders.
Yes,
so the company doesn't have any obligation to give any kind of a balance sheet to provisional balance sheet and all that. Any audited balance sheet is there in the website, so you can that is there.
Yes, sir.
Other than that, the company does not have any obligation to provide. Unlike a company where issuing shares or merger, all those kind of things where companies are only directly involved, so they'll give projections.
Yes, sir.
But if a transaction happening between shareholder A and shareholder B, the company does not have any obligation to give any projections, no?
Correct, sir. But sir, but what happens, as we are talking about all the privately and unlisted closure companies, in order to support the seller and buyer, companies, if they're, as long as they're holding a significant stake, companies will share. But if the companies are the very big companies and also buyer and small shareholder, then as you said, we have challenges, sir. Okay, sir, we discussed now about the fair market value. We will come to that recent amendment later. Coming to the NAV under Rule 11UA2, what we discussed about transfer of shares. Though everybody is aware, I would like to just make what are the points, so what are the practical challenges. For the purpose of transfer of shares, as sir was telling very clearly, in case of transfer of shares, company is not involved, only seller and buyer involved. So, but even the seller and buyer is involved, but the fair market value can be right only taking the data from the company. So there they defined under Rule 11UA2 net NAV method. Who can issue the question now? Since they mentioned method to be adopted, also this is based on the audited affairs or provisional affairs. There is less scope for assumption. Hence, this report can be issued by any person, need not be registered value, or even management can certify. Or any person need not be there is no specific person who can issue. However, companies, they prefer an independent valuation from an outside person. So in such a case, here IBPI registered valuers also we can issue this NAV report. What then we will be taking here is book value of all assets. We will take as on the date of transaction book value as per assets, total assets, other than jewelry, artistic work, shares, securities, and real property. So we will take book value other than these four in the balance sheet as reduced by the income tax paid, if any, less the amount of advance tax refund, amount shown any asset including amortized asset. So here 11UA2 for transfer of shares purpose, we are taking book value of assets other than these four values. I'll come to the other than four values minus advance tax paid. Why we need to take advance tax paid is advance tax paid is not recoverable. This is only paid tax. It will be adjusted for the current year. So amount of advance tax paid is a specific deduction. Similarly, any amount shown as an asset, including unamortized amount, like a deferred tax now. So here what happens like a prepaid expenses, pre-operative expenses, deferred revenue expenditure to the extent of not amortized. Those assets, though appearing in the balance sheet, is not recoverable. It is already incurred and sunk cost. Hence, this should not have any, doesn't have any value, then needs to be eliminated. So from the book value of assets, we need to advance income tax and other assets which doesn't represent any recoverability needs to be deducted. For that, then whatever adjust not considered jewelry, artistic work, shares and securities, immovable property, those we have to add. Price of jewelry and artistic work could fetch in this open market. So jewelry, if the company has got jewelry, what is the open market value? Similarly, fair market value of shares and securities. Whatever we are doing the fair valuation of shares, that needs to be considered. Value of immovable property based on the guidance value. So under the asset side, we will be taking all the assets other than these four: jewelry, artistic work, shares and securities, immovable property, minus advance income tax, unamortized amount. Further, whatever not considered, we will take a fair market value based on the open market. Then we will be deducting book value of liabilities, excluding share capital, free reserves, and any other liabilities for which there is no liability, there is no obligation. So what it says, book value will be considering all the liabilities as shown in the balance sheet, excluding paid up share capital and amount set apart for payment of a dividend. If I got any specific reserve for payment of dividend, that is an obligation. This is surplus. So this net worth, basically the net worth will minus it, minus any amount representing excess provision of tax or any amount representing provision made for meeting liabilities other than ascertained liabilities. Just to say, from asset side, we will eliminate what is recognized asset which is not recoverable, like a deferred tax asset and advance tax. Liability side, other than share capital and reserves, we will need to deduct other liabilities where there is no liability. We made as an ad hoc liabilities. So since there is no obligation to make payment, that amount will be knock off. So this is what will get the net value for purpose of calculation of NAV. Fair market value of equity shares will be A, that is the book value of assets, B, C and D, that is fair market value of jewelry, securities minus liabilities, multiplied by the paid up value divided by equity share. So this is what this is a formula prescribed under Rule 11 UA2 to calculate the NAV method.
Sir, can I ask a question, sir?
Yeah, sure.
You have a tax paid and you have a provision for taxes, liabilities.
Yes, sir.
So you're going to agree to that, sir? I'm assuming that's how are you going to take it here?
Sir, yeah, I think if the company, normally whenever they make advance tax payment, until assessment, they will not pass an entry, sir. So in such a case, amount advance tax is sitting in the asset side, provision is sitting in the provision side.
Correct.
So what we'll do, the advance tax needs to be adjusted against the provision for amount. So advance tax amount will eliminate from the asset side. Similarly, once we come to the provision, to the extent of provision which is already adjusted against the advance tax, we will knock it off, sir.
Yeah, so therefore, suppose if there is a provision for tax is say 100.
Yes, sir.
Liability side. So you have provided for that.
Yes, sir.
And tax is 30. So you are saying that so in the asset side you are taking 30, in the liability side you are taking 100. So effectively you are adjusting for balance 70 is still there, which is part of the liability.
Yes, sir.
So I don't know. So essentially what you're saying is whatever taxes you are paid in showing as advance tax asset, you knock it off in the asset side. Whatever liabilities are there shown in the liability side, you knock it off, you are saying, for provisions.
Absolutely, sir. This advance tax provision for tax, we have to see what is the liability.
Is provision for tax is not a true liability, sir?
Sir, provision for tax is liability. Here, what's happening is not tax. If you come to other things, provision for tax, gratuity, leave encashment, warranty provisions. So, what?
Yeah, but the challenge is sorry, sir. The challenge is the word they have used is any amount representing excess provision for taxation.
Yes.
From a valuer perspective, how does he know the provision that has been made in the books of accounts, to what extent it is excess? Because the regular provision you cannot exclude in the liability side.
Yes,
it's only the excess that you have paid. How does one know about it?
Sir, but one challenge is there. Excess provision means if it is for a previous year, we can make out. If it is for current year, what we calculate is what is the book profit multiplied by that or whatever rate applicable. Then on that, if there is any excess, then we will deduct it. But detailed computation, we may not go. Where there's a disallowance expenditure, if you go for a tax computation, that may be little difficult. Here, what the practice is, excess provision means what is based on the profit, based on the rate, is there a provision for tax is inadequate or is excess? But many of the companies, sometimes the companies, they will make excess provisions, sir.
So you're saying that you are supposed to do the calculations based on the book profit on paper without
Yes,
looking at any. Because invariably what happens is that a lot of deductions one gets it, and all those deductions may not be represented in the provisional financials as on a particular date.
Yes, sir. Sir, but this is actually, sir, here valuer has got a limited role to the valuation, because that's the reason they say it's not like a DCF method where you can take assumption. Here the method and is prescribed. We need to go same provision only. Provision for excess provision for tax, we may not go assessment. I think we primarily look at what is the tax liability based on the profits. But if any other members has done anything, they can share. Sir, Ravishankar sir.
I think here in the income tax purposes is not like a normal fair value. It's only book value.
Yes,
so
sir.
the items relating to taxation are being removed.
Yes, sir.
Okay, so for several times it's like a pre-tax kind of a thing. So what we are saying is that advanced, he has in his example, the advanced tax is 30, provision for taxation is 100 rupees. Actually, there's a 70 rupees of still liability to be paid.
Yes, sir.
Still 70 rupees liability is to be paid. But what the valuation method is suggesting is that remove the taxation part. So remove the tax asset, remove the tax liability also.
Correct.
So other than that only we are doing the, but as he said, really there is a liability of still 70 in this case.
Yes, sir.
But which we are not considering because that is relating to tax.
Yes, sir.
So I think, sir, the way, I mean, because
with permission, carrying that example a little further, what happens is at times because it's a running company, we have to be opting for DCF methodology for transfer of shares from say shareholder A to shareholder B. Then can for income tax purposes a registered valuer undertake this valuation?
Sir, no, sir, that's what, sir. See, for income tax purpose, it said only if you want to go by the DCF method, don't come to chartered accountant. Go to merchant banker and do something else. Because then he can consider in that method, that the DCF method. If it comes to a chartered accountant or any accountant under the Income Tax Act, he has to do this. So if you this method, you have to see whether this method is suitable to you. If you feel this method is supposing book value may be much less than the potential of the share. So you have paid more. In that case, take a merchant banker valuation. Don't come to this method. It's only giving you two options. In fact, I think there is another option also there. Any value decided by the management. I think that is also there here. So then if you can go and justify before the income tax officer, as management, we thought my share is worth say 500 rupees. But if you go with this method, as 11 UA method, it comes only 200 rupees because it's based on book values.
Yeah.
So
sir, also,
sir, there you are talking about issuance of shares.
Yes,
there I'm talking about transfer of shares. So
sir, I'll tell you, sir, I'll add it. Now, for transfer of shares, method is, what is the requirement is NAV method. NAV method is always less than the DCF method. So if you're doing the DCF method, you are getting value will be higher than that. So this NAV method is only for an record purpose, assuming that NAV is 100 rupees, DCF is 300 rupees. So absolutely, sale of share you can sell. The seller is paying capital gain tax and also no issues, sir. We're taking, if in case of if you're selling at the lower than the fair market level, that comes into picture. So if you're going for DCF, it's not mandatory that you need to report, but as you said, you need to have NAV report to show that 100 rupees. And you have DCF method based on that your transaction is concluded at 300 rupees. Absolutely, income tax will be happy because he's getting the tax, sir. Yeah. So,
intangible assets?
Yes, sir.
What about intangible assets?
Sir, as sir was telling, any other method prescribed, It is not applicable for a transfer of shares. That is applicable to issue of shares under.
No. I am asking the books of accounts in the
Yes,
total assets. Some of them may have intangible assets, goodwill assets also in the books of accounts.
Yes, sir. Agreed, sir.
So if you see, you have said we start with the book value of all the assets.
Yes, sir.
Other than jewelry, artistic work, shares, securities, and immovable property.
Yes, sir.
Therefore, the asset side, intangible assets is there.
Yes, sir.
Now, so are we taking the book value of whatever the intangible asset is there as is, varies from an income tax perspective?
Sir, actually, no, answer is there in there. In this case, since this method and also method prescribed under Rule 11 UA, they said book value of all assets other than these things. So we have to take intangible assets also. What is eliminated is amount of income tax paid, and any amount shown as asset including amount unamortized amount which does not represent as an asset. So in this case, the intangible asset doesn't fall under second one because it's not an unamortized amount, and also it is representing intangible assets are part of our valuation. We will be taking the book value, sir. Because we have to follow the method, take book value, eliminate those four, minus income tax, unamortized, and other liabilities, sir. So only we have a scope here, unamortized amount of deferred revenue expenditure. So intangible asset does not fit it here, and hence we have to take intangible assets also as per the audited balance sheet, sir.
Thank you so much.
Yeah. Can I go next, sir?
Yes.
Sir, now I think this is a very new amendment recently on 25th September. What it says is recent amendment, Rule 11 UA 2, they can E and B, fair market value of unquoted equity shares we discussed now. So earlier we had only two methods, FMU and DCF method. Now there are 5 methods. What it says is fair market value of unquoted equity share can be under 5 methods. First method is NAV method, which we discussed just now. That is a existing method. Next is fair market value of unquoted share, merchant banker, DCF. This is also old method. So earlier these two were there. Now they've issued 3 more method, issue of shares by a venture capital fund or specified fund. In this case, the method they mentioned is benchmarking price. So we will come to the benchmarking price. What is the benchmarking price? Similarly, fair market value of unquoted share. So this is a big area for merchant banker. Unquoted share, merchant banker, you can use 5 methods. Here, if a merchant banker using DCF method, it comes under here. Also, merchant banker, apart from this DCF method, he has got 5 more methods. And also notified entity for benchmarking price. So this is a new amendment which they given a lot of new methods. For all these methods are only for a merchant banker, not for a chartered accountant, not for a registered valuer. Also, here, one more complex. If a shares are means resident, NR means non-resident. If a shares are issued by the company under section 5627B to a resident, 4 method A, B, C, and E is available, but not D. It means that if a private limited company issuing shares to the resident individual, merchant banker can use only DCF method, but he can't use a 5 method, which we are going to discuss. However, if the shares are issued to non-resident, merchant banker can, all 5 methods are available. This 4th method, that is a merchant banker can use the 5 methods. So I'll come to that details. Next is under B, fair market or CCPS, compulsory convertible preference shares. For that also, the same methods are applicable. Issued to a resident and non-resident. So what has happened is in this recent amendment, the 2 changes has happened. One is earlier we had 2 methods. Now they issued 3 methods. And the 3 method, merchant banker has given 5 method options. However, this merchant banker, this method can be used only if the shares are issued to non-resident, but not for resident. So here, first of all, we had a confusion on the income tax act, which method to be used for what purpose. Introducing a 5 more methods in that resident separate method, non-resident separate method has given a furthermore challenges which method to opt. Another rule is they very clearly in the rule they mentioned merchant banker report is valid for 90 days. So they clarified now. So up to 90 days the report can be used. Rule 11 UA4 safe harbor rules. This is a welcome change because most of the times we used to find IBBA registered this when predominantly when issuing of shares has happened, when a XYZ private limited company issuing the share, he will take a one IBBA valuation report, say he will give 120 rupees is the fair market value. So company has to allot above the fair market, above the issue price, above the fair price, more than 120. But income tax says if you issue more than 120, then you have to pay tax. So it's very difficult to get on dot one report from IBBA registered valuer for Companies Act purpose, one report from a merchant banker for income tax purpose on dot. So because of that, they given a 10 rupees, so 10%. So this is a welcome change. Now, what is change happened? As we discussed, more methods are notified and issue of shares. 5 additional methods are notified. Fair market value of unquoted shares for the purpose of 5627B shall be the value. Option is there. Now, in case of resident, these 5 methods what we discussed now, issuer can choose any method. So what he has to do is go multiple methods, arrive the value, wherever the price suits for him, he can choose. So it's not that out of this 4 or 5 methods, issuer can choose any method. So fair market value of unquoted equity share for purpose of section 5627B shall be the value on the valuation date at the option of the auction. In case the shares are issued to resident, methods value determined under class A, B, C or E. D is not applicable. D, there are 5 methods. In case of a non-resident, value determined under rule A to E. So one needs to evaluate whenever proposal company takes up for issue of share. One valuation will go to the IBBA registered valuer. He will get an amount. That is a benchmark price. Board can decide the above the board issue price can be above the registered value report. When it comes to income tax, fair market value. In case of resident, there are 4 methods. In case of non-resident, there are 5 methods. So challenge here is you need to appropriately decide which method will suit. In both for A and AA, this NAV method. So the NAV method definitely is not suitable. NAV method can be issued by a CA or even management. So next goes to the merchant banker DCF method or merchant banker specified method. So here the challenge is opting for which method is in one of the critical factor to conclude the transaction. Class D is not available for issue of shares to resident shareholders. Now, we discussed NAV method. There are 2 methods are there. We have been telling about rule NAV method and rule 11, UA1 and UA2. UA1 is applicable for a transfer of shares. We discussed net adjusted book value. When you say net adjusted book value, we discussed book value of assets other than jewelry, immovable property, securities. So it means that if the company has got a huge land bank bought 10 years before, when you go for NAV method, you will be taking the book value of assets and immovable property will be taking guidance value. That is the NAV method. That method is applicable only for transfer of shares. Here, right now we are discussing about NAV method under rule 11 UA2. UA2 is for issue of shares. For issue of shares, the adjusted method is not there. Here method is very clear. Book value or net worth of company computed on the basis of carrying value. Fair market value of unquoted shares. Book value of assets minus liabilities multiplied by paid up value of share divided by total amount. So if you analyze both differentiation, in case of a transfer of share, there are certain adjustments are possible for bringing the market value and also liabilities. But for issue of shares, it's very clear, take assets minus liabilities, not even provision for tax, whatever discussed. So this is a one change. Who is authorized to issue? Since the law is silent, anybody can issue. IBBA registered value CA or CMA or management also can issue. Second method, out of 5 method, A to E. A is NAV method. B talks about DCF method and merchant banker. So here the problem is only merchant banker, he can issue DCF method following internationally accepted methodology. This is also old method. Third one, benchmarking price for venture capital and also for specific transactions. So that also has to be issued by only merchant banker.
So the share to be transferred, and they have intercompany holding also.
Yes, sir.
And that suppose the intercompany holding is 2%, 5% in other
Yes,
private companies. Do those valuation need to be done, or it has to be done only when they have a associationship or a holding? Because 5%, 2% is very small amount holding in other companies.
Yes, sir.
So do we have to take the valuation for those companies even if you are holding 2 to 5%?
Sir, I got your point. When for transfer of shares, rule 11 UA2, when you take the book value of assets other than securities we will take a fair market value as per the same method. Again, if I got investments in other group companies or mutual funds, I need to take market price or NAV method. So here the challenge comes, as you're saying, if it is a 2%, 1% rule, there is no leeway of how to be adapted. So as you say, other companies take balance sheet as on the date or as on the most appropriate date closer to that, and do the adjustment based on the available data. I think we need to take. Next question is, if you got intercompany holding between cross holding, we need to use the simultaneous equation method. We need to arrive. Straight answer to your question is, since there is no leeway for this percentage, we need to follow same method to the extent possible. So the challenges comes into picture because of not available data. I think again we may have to prove to the assessing officer saying that the differential amount whatever we are not getting is not a significant.
Right. Thank you.
So now we are discussing about new amendment specified 5 methods. There are 5 methods: comparable companies, multiple method. This is, I think, we are aware about this comparable companies pricing method, probability weighted expected return method, option pricing method, milestone analysis method, replacement cost method. So this is a new method permitted under Rule 11 UA for calculating FM fair market value, and also only shares are issued to a non-resident shareholders. So then, apart from a traditional NAV method, DCF method, merchant banker can use these methods. Comparable companies, multiple method. He can compare what is the benchmarking company, what is the benchmarking, he can proceed. Probability weighted expected return method, option pricing method, milestone analysis, replacement. So these are methods permitted. Next is notified entity, benchmarking prices method. So just to sum it up, the rule of the newly amended rule, it is given more options, and all are only for merchant banker, not for a chartered accountant. And each method also they also specified benchmarking price. Assume that one transaction has happened in say in the month of January, same price without further valuation within 90 days they can proceed with the one more transaction. So that is a benchmarking price. Merchant banker report is valid for 90 days as we discussed, Rule 11 UA. Safe harbor rule, I think this is a welcome change. Whatever is giving valuation report, management can decide, in the sense up to 10% threshold is permitted.
Just sorry to interrupt you. One question on the previous slide.
Yes, sir.
When you say merchant banker report is valid for 90 days,
yes, sir,
is it the date of the valuation or date of the report?
So date of valuation, sir, because date of report I can get later, but the date of valuation is relevant. No?
Okay. Yeah. All right. Thank you.
So now, how to fix the price? In case of now, this is I'm interplaying with the Companies Act versus Income Tax. In case issue of shares under the Companies Act, issue price should be more than or equal to fair value what we arrived as the IPP register value. In case of issue of shares under Income Tax Act, Rule 56(2)(7)(b), it should be less than or equal to fair market value. In case of transfer of shares, transfer price under Income Tax Act, less than, more than. So income tax once we get the IBB registered valuer, that is the minimum price. Board can fix the issue price above the fair value. In case of a same transaction, under the this is covered under section 622(1)(c) of the Companies Act. This is covered under section 56(2)(10). Same transaction, once you get the report from a merchant banker or CA, issue price should be less than or equal to the price what is arrived. Next, coming to we discuss transfer price. In case of a transfer of shares between seller and buyer, here the company is not involved, so transaction can be more than the fair market value. So in this case, in case of issue, higher cap. Here in case of transfer is a lower cap. Same thing if you take for FEMA, in case of FDI, transaction price should be more than or equal to arm's length price. In case of ODI, less than. Companies Act says value, you cannot exit shareholders value, you cannot deteriorate, you can go for a more than value. So I think income tax says issued share less than or equivalent to. So the logic is when FEMA, each act has got its own purpose, its own objective and also purpose. So we need to balance while doing the transaction. Securities we discussed. I think yes, sir.
So may I ask a question, sir?
Yeah.
So
Please.
with respect to this point number 1,
Yeah.
I'm not sure, but when we fill pass 3, it asks a question: Are you issuing share price share below than the fair value by registered valuer? If yes, then give your reasons.
Exactly.
So does this indicate that a board can issue less than the fair value given by IBB registered valuer?
No, absolutely no. Who is I'm saying more.
No, my question is, sir, as if we see the past 3, it says if you issued shares below fair value, then justify. In the past 3, this option is there. So I have not practically seen that, but considering this option is given, so does this indicate that a board have power to issue less than the fair value by IBB registered valuer? Academically, I'm asking this question.
Agree.
Because if we see the past 3, anybody who has filled past 3 maybe can throw some light that, it has an option there that in case you're issuing below than the fair value by IBB valuer, then give the reasons for doing that.
Maybe I think PS3 I don't trigger. Normally, as per IBB, the valuation rules, board cannot fix the selling price below the fair value. However, in order to trigger, but at the same time, the board is deciding under the exceptional cases. I think it is the form is asking for ROC to take an action and also to get to know. But according to me, rules doesn't provide issue shares less than the fair price.
Okay.
Yeah. The securities, I think same definition as section 2. Yes, sir.
Sorry. The previous slide, the challenge is in the Companies Act, when we do the fair value assessment as a registered valuer of IBBI, if there is a significant value for intangible assets, we do value the intangible assets, even if it is recorded in the books of accounts or not, because there is a genuine value of intangible assets.
Yes, sir.
From an income tax perspective, we just stated that because of the 11UA standard prescription model, whatever the book value, at the most, that much only can be considered for intangible assets.
Correct, sir.
If it's not even there, then you don't even consider it. So in that case, there may be a huge gap between the value of fair value under the Companies Act and another Income Tax Act.
Agreed. Under the Companies Act is only one method. Under Income Tax Act, Rule 11(2), there are 5 methods are there.
Is this only for 11(2) or this is also for 11(1)(c)(b)?
Sir, 5 methods is applicable only for 11(2), sir. In case of 11(1), only one method, NAV method. The 5 methods are not applicable.
Correct, sir. So therefore, in the case of 11UA for issue of shares, so 11UA2 only is applicable for issue of shares, you're saying. For 11UA1 is not applicable for issue of shares, right?
Yes, sir. Sir,
okay.
Now
the question is, in the case of transfer of shares also between the two entities, the buyer and the seller, willing buyer, willing seller, would definitely look at the intangible asset value.
Correct, sir.
Therefore, there will be a fair value which could be significantly different as compared to the fair value arrived from the income tax method, primarily because of the intangible asset.
Agreed, sir.
So
So now, I think if I understand you correctly, in case of a billing by a seller and if they wanted to identify the intangibles, see what is plus is minimum, what is the minimum fair market value is minimum price. Assume that the NAV method is 100 rupees, but based on the considering the intangibles, if the seller says, I'll not sell at 100 rupees, I'll sell at 250 rupees, then he can sell. So what we're saying is it can be more than the fair market value. In my case, what is required is to document what is the 100 rupees, is it FMA 100 or 500? When you do the transaction at 250 rupees, you give us a NAV report which says the 100 rupees. So income tax is permitted more, it is permitted more than the fair market value. So I think there's an option is there, sir. They can normally they can do, but it's not mandatory. But in case of issue of shares, the transaction price should be less than or equal to. In case of transfer, it can be more than that. When it's more, in any case, seller is paying the capital gain tax, sir.
So thank you, sir. Okay, sir.
Sir, the shares, the same definition, shares and securities, I think we already discussed now. What is excluded is under 56. Now, I think we have concluded transfer of shares, issue of shares 5627B, and a new method. And under 5627B, the two entities are not covered for this condition. Venture capital undertaking from getting money from venture capital company, and also notified companies, sir. So notified companies are these startups. Sir. And one condition just to recollect is for startups, there are some conditions are there. They need to fulfill the conditions as per the department guidelines. In case if they fail to fulfill the conditions, then they are subject to the whatever the tax they are not paid earlier, then they have to pay. This is about the clarification from the Income Tax Act. So here I wanted just made one illustration where transfer of share tax implication. We discussed about the transfer of shares, income tax regulations, various methods, who can issue. Now, tax implications to the shareholders. So, if illustration one, if ABC private limited company has two shareholders, E and B, they are holding 50% shares each other. The company made rights offer of rupees 200 of rupees 20. The company made rights offer of 20,000 shares of rupees 100 each. Face value is also 100, whereas fair market value is 800 rupees. So this is a rights issue. Fair market value as per NAV method, what we discussed, adjusted NAV is 800 rupees. They are issuing at 100 rupees because face value is 100. The question is, both shareholders subscribe the shares in the same ratio and post issue share remains same. So in this case, does any tax implications to the shareholders? Any views?
Economic value is the same, so I don't think there should be any tax implication.
Yes, sir. Absolutely, sir. So nothing is taxable in the hands of both the shareholders, even though the shares are already 100 rupees when the fair market value is 800. 56,210 not applicable transaction, and 56,270B is also not applicable for this transaction because it is a very clearly they given saying that it is an economic value. There is no change in the shareholding. Situation 2, same example, taking same example. ABC Limited, two shareholders, 50-50. They made rights offer 100 rupees and fair market 800 rupees. What has happened is the one shareholder subscribed for 10,000 shares and another shareholder did not subscribe for the issue. And post issue, shareholding, because of other person has not participated, shareholding has become 75-25. So in this case, do we foresee anything for the shareholders?
So 56,210 might trigger.
Yes, sir. So EO tax, asking capital tax 700 rupees because 800 rupees is the fair market value, 100 rupees is the issue price. Difference element 700 into 10,000 as a property issued without adequate consideration under section 56-210. So this is a method. However, now the challenge comes, 56-210 should be applicable when we receive the property from other person. In this case, the shares are allotted has come into existence on the date of allotment. It was priorly, it was not there. So there are multiple views for the same section. What I said, normally for transfer of shares, 56(2) is applicable. There is no doubt. For issue of shares, if a company issues less than the fair market value, and company anyway is not applicable. But for shareholders, multiple views are there. They are saying it's not applicable. But as long as the same proportionality is maintained, no issues. But if there is any disproportionality is there, so income tax are going on heavily saying that you got benefit. Earlier you had a 50% worth. Now because of betting 10 small amount, your voting percentage is increased. Accordingly, your entitlement of benefit is increased. So whenever in case of rights issue, predominantly company secretaries will be doing that. Even many times preferential allotment will convert into the rights issue, will make it. So for Companies Act, we can say that the rights offer we issue to the shareholder, they have not opted for it, is okay. But when it comes to income tax, they will see what is the holding before allotment, after allotment. If there is any difference in the shareholding and FMV, there is any difference, then they'll ask for the income tax. Same situation.
Chandrasekhar, in this case, the
Yes,
second
sir.
situation,
Yes, sir.
shares are not in existent.
Yes, sir.
So there is no asset, right? But there is a right to subscribe for the shares at a concessional price.
Yes, sir.
That is being transferred, no? So that is why this income tax problem comes.
Yes, sir. That's right. So, but as you said, if there is a disproportionate allotment, I think income tax.
That's right. That's where I have a right to subscribe, which I am foregoing. So forbearance of a asset also is a transfer that way.
So other persons got more benefit.
Right.
So what will happen in case of a renouncement in favor of another person? Is instead of two people, one more person is added into the list of shareholders?
Same, I think. Okay, instead of these two, then a third person applies for the shares. So.
Yes, sir. What will happen in that case?
That's clearly right. There's clearly a transfer, no? You are right. You have transferred to third party. There is a clearly transfer.
Correct. So in the same case, assuming that A is applied for 10,000, if a B is given is a right entitlement to C, then C for a C it's a benefit only. So same value 700 into 10,000 because C his entitlement is given B, his entitlement is given to the C. So it is a clear transfer of rights. And if the issue price is 950 rupees, fair market, since fair market is 800 rupees, the differential between 150 subject to the 10% of safe harbor rule, again company comes into picture.
Sir, I just want to hold on to that example of ABC only, sir, where in the if we can just stay in illustration one. So A, B, C, A and B are two shareholders having a shareholding of 50% each. Now A and there is a rights offer. A continues to subscribe to his share of whatever he is required to subscribe, but B transfers it to C. In that case, is only C liable to tax, or is A also liable to tax on the differential 700 rupees into the?
Now in this case only C, because he is the person who is getting benefit. No, B his shares is transferred 700 rupees, what the benefit is given to C. 10,000 shares and 700 rupees, C is liable for, because C is the person who is getting benefit, subject to 50,000 rupees. 700 whatever getting benefit minus 50,000 rupees is the C is liable for tax.
Noted, sir.
I think we need to see carefully because section 56(2) is under other sources. So that's for one person. 50 CA is under capital gains. So that is for the
seller.
Seller. Supposing in this case, he sells it for 950 rupees.
Yes,
the other example what he was giving.
Yes,
so 800 wala he sold for 950. So the seller is getting, transferor is getting a capital gain.
Yes, sir.
Okay, so if you make it less, one fellow will get a capital gain. More, one person will get capital gain. Less means other fellow will be charged under other sources.
Yeah, sir. Actually, here one point, I think very important. In case of transfer of shares, if a shares are sold above the fair market value, buyer has no issues. Seller will be paying in capital gain tax and the higher amount. But if it is sold at a lesser than that, the differential amount will be levying the attract both the tax, because buyer you will be paying as an 56,210, the difference element as a benefit received. For a seller, you will be paying the notional capital gain tax, assuming that 800 rupees. Just to, I think there is some example, assuming that if the fair market value is 200 rupees, if it is sold at 300, and 100 rupees seller is paying on the 300 rupees capital gain tax, and the buyers no. Instead of that, if a buyer shares are sold at the 100 rupees, if the fair market value is 200, seller has to pay capital gain tax at 200, and also buyer has to pay 100 rupees, treating as 56,210. So this is very important while doing the transaction for transfer of share. It should be, that's the we mentioned earlier, transfer of shares, transaction price should be more than or equal to the fair market value, hence no issues. If it is less than that, the differential amount will attract tax in both the hands. I think that is there in maybe in previous next slide.
One small clarification.
Yes, sir.
You're talking about 950 rupees. That it is the renouncee is in the case of renunciation, it is paid, is it? Face value is of the shares are 100 rupees only.
Sir, I didn't get the question. Can you repeat?
You're talking about 950 is what you have the existing shareholder is selling it to the new shareholder.
Sir,
I mean, B is selling it to C.
Yes,
So
sir.
950, who is going to get? Is it a company or is it that B is getting it? If it is getting company, that how B can be, that capital gains can be levied.
Sir, actually, here we're talking about issue. The transfer shares, that is just, I think it has come. So this is an issue of shares. Both we're talking about, sir. Company and also recipient. There's no seller here.
No. Renunciation is, that transferred from B to C.
Correct.
Okay. You are talking about renunciation fees or the 950 which company directly getting it. If company is directly getting 950 rupees, that C is subscribing the shares at 950, which is higher than the FMP.
Sir, 1 minute, sir. Sorry. Actually, our example holds good only up to here. The 950 is a different illustration. See, if the shares are issued 950 rupees, then there's no benefit. Assuming that if you take, if the fair market value is 800 rupees, if the shares are issued 950 rupees, buyers will not get any impact. The company will get impact. That's only just I've added. If instead of 800 rupees, instead of 100 rupees, the issue price is 950 rupees, shareholders will not get any tax impact. Company has to pay 950 rupees. The company is liable for income tax on 150 rupees multiplied by the number of shares issued. I think this is a slightly, it's not different illustration.
Okay.
So now coming to, please.
I think the same thing, sir.
Yes, sir.
Well, suppose if there is a 50-50 shareholding is there.
Yes, sir.
And you are given in situation one, if both have subscribed equally at a particular price, it doesn't matter.
Yes,
that's what you said,
yes,
right? Now, I'll give a different scenario. Both have a rights to subscribe to 10,000 shares each. One person subscribed for full 10,000, other person subscribed for only say 3,000 shares.
Sir.
Then the other person always had a right to subscribe. We just didn't subscribe. We didn't have money to subscribe, whatever.
Yes, sir.
Are we saying then how much will be the tax? What is the tax impact here and how does it work?
Sir, actually, as you said, but now what income tax looks at in this case, if a second person subscribe for say 6,000 shares instead of 10,000 shares,
yeah,
what they will, I don't know, this is practical. What is the total NAV of the company multiplied by the 20,000 shares free? What is the benefit? So if you calculate in the post on 4,000 shares, what is foregone? So B, that benefit is occurring to the A. So I think this is a little arithmetical, but what income tax looks at it is, if any person is getting any benefit by virtue of the transaction. So as we discussed, if you take the same example, bonus shares, not at all applicable because pre and post holds good, same thing only. The problem comes rights issue, preferential allotment. Preferential allotment is applicable. Rights issue, it is only just documented, but actually the intention is to benefit some shareholders.
See, the challenge is like this. When I am subscribing and large number of subscriptions there, shares are, people are there for rights issue,
Yes,
as a subscriber, I don't know how many would not subscribe or how many would subscribe and to what extent they will subscribe. Okay.
Yes, sir.
Now, suddenly, if you start putting me taxes onto that, just because some other people have not subscribed fully or partly,
Yes, sir.
my effective price goes up because of the taxation, and it might be not beneficial for me to subscribe at all then because of that others' actions.
I fully agree, and it might have a negative impact on the market, on the investment scenario.
Sir, actually, one point I want to. This is, as you said, this is not applicable for listed companies. As I understand, if it is a listed company widely held, there is no option. So these rules are not applicable for listed companies. Point number one. Point number two, closed. This is applicable for closed-held companies. Predominantly, they will have some idea, but even closed-held companies, sometimes there will be thousands of shareholders are there in some cases. But in such cases, I think again we have to see whether is it a company in which public or substantially interested. Cooperative societies, they will
Are there case laws on this, sir? Are there case laws where they are taxable at all in such cases?
Sir, there are some case laws. If time permits, we have some case laws, and also the income tax they levied whenever there is a disproportionate allotment, sir.
Okay, thank you, sir.
Sir. Next, sir, now we are coming to the fight between Companies Act and Income Tax. Companies Act says price should be greater than issue price should be more than the fair value. Income Tax Act says it should be less than that. This is for 56(2)(7)(b). Again, sometimes I'm mixing. Transfer of shares is over, allotment is over. I'm coming to little some of the conceptual points. So what is required is IBB registered value given 100 rupees. You can allot shares more than 100 rupees. Fair market value say 100 rupees. You have to allot less than 100 rupees. Since we can't get more, in this case, equivalent price. So 100 rupees is the price. However, luckily, thanks to the income tax, now they are given a 10% valuation. So the value, fair market value, whatever is getting, so if you get a 105 rupees, issue price can go in somewhere we can balance. So in nutshell, we need to balance IBB registered value report, merchant banker valuation report. We have to equal. This is a difference between these two. No, just to say, for issue of share, valuation report requirements in the Companies Act and Income Tax Act. As we discussed, right, under the Companies Act, we have a rights issue, preferential issue. Rights issue can be at par or at premium. Preferential issue also sometimes at par or at premium. Now, we want to know whether when is reported is required from IBB registered value, when is not required. Under the Companies Act, if a rights issue are offered, rights issue offered at the par, not required, even if a premium not required. So just to say rights issue under 62(1)(a), as per Companies Act, IBB registered valuation NRV is not required. When it comes to Income Tax Act, even though it is a preferential issue, if it is at par, sorry, this is a Companies Act, so if the preferential issue even at par is required, so here either rights issue or preferential allotment. Under the Companies Act, absolutely no issues, no valuation report required for rights issue, whether at par or at premium. In case of a preferential issue, even if issued at par or at premium, valuation report is required from that is the requirement of Companies Act. When it comes to the Income Tax Act, they're not looking for the rights issue preferential offer. They're looking for is it issued at a par? I will not issue. No valuation report is not required. If it is issued at a premium, valuation report is required. Preferential issue. So this is summary. Just sometimes we'll be discussing whether valuation report is required or not. Under the Companies Act, rights issue not required. Preferential is required, whether at par or premium. When it comes to income tax, you will see whether is face value not required. At par, fair market value is not required. If it is at premium, valuation report is required. So this is some I thought just to share about the what is implication and when is required valuation report of the Companies Act and Income Tax Act.
Sir, I have a question. Sir, why just for the academic purpose, why Companies Act has not mandated issuance of report and in case of rights issue? Any logic behind
the right? Yes, the logic is this. What's happening is, as we discussed, the company belongs to the shareholders. Normally, as per the law, all the shareholders have got rights offer. So If the value of share is say 100,000 rupees, if they're issuing 100 rupees, then all shares will get same benefit, no? So that's the reason. Rights issue, what is the rights issue? You are offering to all the shareholders in the same proportionate. It's not required. If you go preference allotment, you are deciding on your own, then a valuation report is required.
Right, thank you.
Yeah, under the FEMA, valuation report is required when the share is issued to FDI, irrespective of whether rights issue preference allotment, other than subscription MOA, just the FEMA valuation report is required. So I think this is merchant banker, this same issue. I think we already discussed now. Just to say, IBP registered valuation report registered value can any method, market method, DCF. This is only about the pointers. IBP registered value can issue use the as per industrial valuation standards as the market method, DCF method, NAV method, depends upon the suitable method. CA or CMA must follow only NAV method, rule 11 UA 1. Merchant banker, DCF method, 5 rules. So here we discussed about the NAV method under rule 11 UA 1 and also 11 UA 2. 11 UA 2 is for issue of shares. 11 UA 1 is for transfer of shares. For transfer of shares, we discussed balance sheet means as on the date of transfer only. So if the transfer is happening on 14th October, income tax says I want on 14th October only for transfer of shares. So that's a big challenge. We discussed how to overcome. You take a latest available balance sheet. In case of NAV, here we are using net adjusted book value. In case of transfer of shares, we are using the NAV method. Book value, there is no adjustment is required. But here, balance sheet is not, latest balance sheet is not available for at the time of issue of shares 5627B. We can take the latest and balance sheet which is adopted in the AGM. So this is for issue of shares. If you are going for a NAV method, latest audited financials can be used. In case of transfer of shares as on the date. However, here this NAV method may not be suitable because when a company is issuing a share, they will be going for a higher value. So this NAV method price will be very less. So this will become only theoretically, but it may not be practically required. Practically, it will be useful. It may not be useful. Valuation of unquoted preference shares, other securities covered. I think this is a repetition we discussed already. Again, okay. This is a transfer.
Sir, one question. In case of transfer of shares other than unquoted equity shares,
yes, sir.
So the rule 11 UA 1 CC applies.
Yes, correct, sir.
Right. So there it says the price it would fetch in the market as determined by a merchant banker or a chartered accountant, right?
Yes, sir. Correct,
So
sir.
does it mean, suppose for those security, let's say CCD or CCPS,
yes, sir.
So anyone, any chartered accountant or a merchant banker can issue the report. Is this statement true?
Yes, sir. The merchant banker or their accountant or the CA or merchant banker can issue. Depends upon the method. There also method is not specified. So whether a DCF method appropriate, and especially the Ravi Shankar sir discussed just now. If the shares are coupon rate is say 2% coupon rate, if the market rate is 8%, then we need to do the appropriate adjustments, sir.
So if a chartered accountant is using a DCF method, I mean, would that report be okay?
It is okay. So DCF method means need not be exactly the free cash flows. If it is the entitlement is a preference shares, if they're 2%, then DCF there will not be using the projected business projections. We may have to use what is the benchmarking rate of dividend. So it depends upon instrument.
But I mean, DCF can be used by a chartered accountant, right? In that case, transfer of shares.
Their method is not specified. Appropriate method can be used.
Appropriate method.
Yes, sir.
So practically,
and second thing.
So practically is what Munish is saying. Practically, the venture capitalists are not accepting CA report. The argument they are taking is that because they say the underlying valuation is done by equity and that is done by DCF, and income tax DCF equity is only by merchant banker, so they are denying. Though law do not say specifically, but many of the venture capitalists have rejected reports of CA in this case. Practically, this is what the situation is.
No, but Sumit, there are two views in this. We are dealing with some of the VCs and AIF. So some AIF, see, because of the costing angle, they take CA report, and that is okay. I mean, they themselves say that take the CA report because MB report is more costlier than a CA report.
Yes, sir. Sir, just to answer the question, I think it is not right. What mentioning in case of merchant banker, DCF, they mentioned under two situations. But in the rule 11 USCC is mentioned as it's not a merchant banker. So here CA can issue, it can use the DCF method. It is a person and method and purpose also. We need to see all three, sir.
And sir, if we take take this to issue of, let's say, CCDs.
Yeah.
If there's a case of issue of CCDs and conversion is 1:1, so then 11 UA 1 CC, does it apply?
Is it for issue or transfer?
Issue.
It applies, sir.
It does not apply.
No, it applies, sir.
No, but 11 UA 1 is specifically for transfer of.
Correct.
But when we are issuing CCD, how does it apply then? Literally speaking.
Sir, you're talking about issue. That you're talking about issue from the company to issue, no?
Suppose company ने CCD issue किए हैं.
Okay.
Then which rule will apply?
Rule 11 UA2 it applies.
No, but 11 UA2 talks about issue of share, not debentures.
I know 11 UA2. I think
if you take 11 UA2 is issue, right? 11 UA2A is issue of unquoted equity shares or quoted, and 11 UA2B that is for CCPS now.
Correct. Yeah.
They are still silent on securities other than unquoted equity share and CCPS.
I got it. I think maybe I think still it is not covered. Yeah. So now just continuing our answer this one, it is just a comparison. Rule 11 UA1, Rule 11 UA2. 11 UA1 is applied for transfer. 2 applies for issue of shares. Here method permitted is adjusted in NAV. What we discussed, book values of 4 jewelry, immovable property can be adjusted. Here pure book value. In case of here 2 fair market value will be certain assets are captured. Here there is no end result will be this NAV will be higher than this one. This will get it. This is just comparison purpose between 11 UA1 and 11 UA2. Here the balance sheet as in the transaction date. Here the balance sheet as in the latest AGM or adopted AGM can be adopted. This is about it.
Sir, what would been the question that was posted by Muniji? What is the status of valuation of CCDs under the Income Tax Act? Is it required? What is practically being done? What is practically being being in the regime in the assessments and all those things? If other members can also share their views.
Yeah, other members can share. I think I had not come across. Maybe any other person, sir. Ravishankar sir, anything
so
come across,
practically, see, CCD, if the terms are fixed, it's a 1:1. Then essentially what we are issuing is a 1 equity share only. Okay, so at the time of so essentially whatever is the value of the equity share rule applicable as per the income tax rule, we should at least try to do that, because if we are issuing the CCD at a price above than the fair market value of the equity share, then in future we might get the income tax adjustment. So it's better to do the equity share valuation and then issue the CCD at that value.
Okay, sir, I think I'll take another few minutes. I close it. 56.210. Just to clarify, if Yes, transfer of shares from one person to another person happens to fair market value, no problem. If it happens less than the fair market value or without consideration, there is a chance. When less than fair market value or without consideration, if the differential amount is less than 50,000 rupees, which is permitted under section 56 to 10, no problem. If that is more than 50,000, so here that covered, there shall be tax. No, I think that's what we discussed. I think somebody is asking. If a shares are transferred without consideration or inadequate consideration, if the difference is more than 50,000, the resultant shall be taxed as income from other sources from the to the buyer, and similarly, even seller also has to pay the tax. The resultant shall be taxed under income from other sources on buyer 56 to 10. Same amount shall be taxed under the capital gain tax. So as we discussed, the fair market value is 200. If it is sold at 210, absolutely no issues. If it is sold at 100 rupees, seller will be paying a capital gain tax on 200. Buyer also will be paying an 210 minus 100, and 110 rupees will be attracting twice the tax. So whenever it comes to the transfer of shares, we need to ensure that it should be above the fair market value, but not below. So this is one thing I thought, just this summary of this one. A transfers 1,000 rupees. A transfers 1,000 shares, face value of rupees 100. Fair market value is 1,000. Transfer is also 1,000. No issue. Seller will pay capital gain tax 1,000 rupees. If a fair market value is 1,000, if it is sold at 450, seller has to pay capital gain tax on 1,000 rupees, and buyer has to pay the tax again of 550 rupees. So this seller is always in the capital gain tax, but he has to pay more. The 550 rupees, what are the benefit? It is a tax on the twice. So if it's a seller, FM is 1,000, if it's at 1,100 rupees, absolutely buyer has no impact. Only in the 100,000, 1,100 rupees is a tax for capital gain tax. This is about structuring transfer of shares. I think the other things we covered now. This all. Startup exemption, I think, is covered. So I think this is what I covered. Issue of shares, income tax, FEMA, IBC regulations. So if any further issues are there, we can take it up now.
Actually, many of the points were raised in the chat.
Yeah,
so if anyone would like to address it to the speaker, please unmute yourself and go ahead.
So I have one query, just a thought on practical challenges.
Yeah.
Now, a lot of people see we have typically in the case of promoter, he wants to transfer some trust shares to a ESOP trust and things like that. They want to get book value. Now, the challenge is most of the early stage starters has a lot of dilutive instruments there, which is in the form of CCPs and everything. Now, when I go by strictly the rule 11 UA, it provides only for denominator of equity shares. And it takes CCPS and everything as a debt. Now, practically, what is it that everybody does for these kind of situation? Do you provide it at this diluted basis, the NAV, or how is it done? Just to get a thought process there.
Well, I'm practically not handle, but one thing is very clear what the requirement is in case of rule 11 UA, one for transfer of shares. I don't have any option of taking the diluted. I think I need to go the NAV method only with the outstanding number of shares. So
if I do that, then all the premium of the CCPS goes on to the equity, and the equity value is quite high. Where if you're trying to do a very low value transaction, that there is a challenge. I see some of the merchant bankers saying that they're okay to issue at a fully diluted basis, the book value itself. So just wanted to pick, because we always stood by the thought process that you cannot do FDB kind of issue, and you have to go strictly by how the formula works.
For the income tax perspective, in one case, It was CCPS, and it was a mutual option between the investor and the promoter to convert at any point of time. So we have taken a management representation stating that they shall be converting at par, and that's a statement we have taken. And because end of the day, it's a revenue, 1CB and all that, it's a management representation is very well good enough. And based on that representation, we have converted as equity and moved ahead. Because I think the larger thing is, the purpose of this is essentially income tax wants to ensure that if there's a benefit, they want to tax. If there's no benefit, they don't want to tax. So given that intent of the law behind it, whatever actions or whatever assumptions you take, as long as it is workable within the framework, we can do it. I mean, that's the presumption I.
Yes.
Okay. Okay.
Most
Perfect.
of us
Thank you, sir.
adopt, that fully diluted basis only. The reason is that, that ultimately the equity shares, which is fetching a benefit, that CCPS is ultimately, CCPS or a CCDs will be ultimately converted into equity. So most of us would, especially income tax purpose, we work on the fully diluted basis.
Diluted basis. Okay. All right. Yeah. Thank you.
Sir, I have another question. That some time back, some gentleman has raised a point saying that, that in Companies Act, PS3 filing, that there is an option available, that whether, if you are issuing less than the fair market value, then quote the reason. So practical situation is there are quite a few situations, that we will be issuing at less than the fair market value. Also adopts it. The reason why it will adopt is that, that unvalued round or a non-valued round, that what happens is that most of the cases, that next round valuation, certain discounts are fixed. In that situation, in that MGT 14, that we have put the terms very clearly that in the next round, in next valued round, that will be applicable certain percentage of discount. At the time of issue itself, clearly it is mentioned, that ROC also accepts it. That is my opinion. If somebody differs it, I just wanted a clarification on that.
I think what is it? That is a logic. I don't have any different opinion. I think I also am on the same opinion. Any other members have got any different views?
No, but are you saying that in past 3 we can fill that shares are allotted at less than fair value and it is okay?
When the pass value, you see, it is not a valued round. That today I'll issue a CCPS saying that the terms of conversion is next valued round, that I'll give a 20% discount. Let's say that next valued round happens within 6 months, I will do a 20% discount. At that time, I'll file only MGT 14. I'll not file a pass 3 because it's a CCPS issue. That for CCPS, I'll be anyway doing it. When the conversion happened, that PS3 will be filed, and along with that, that we will give a justification saying that why it has been less than the fair market value. For a simple reason is that, that the issue has happened, that 6 months earlier, or, that person has deposited the money 6 months earlier, and since there is no valued round at that juncture, that subsequently the valued round happens. This is a practical situation, and most of the, the VCs are doing it in this fashion, that it is also with the clarification, ROC is accepting it. 1 or 2 cases, it has been accepted also. I think anybody else has, that got a notice or something like that. I just wanted a clarification. In my opinion, it is possible. It's practical also.
So basically, you are saying when you are issuing a CCPS, let's say at a non-fixed price round, right?
It's not a fixed round. It's not a valid round. It is an unvalid round. That what happens is that subsequently valid round will give a discount.
So it's a not fixed value round, right? You pegged it to the next round valuation, right?
Yes.
And because you
discount the next
early,
valuation round.
Yeah, because you have come early as an investor, so I give you 10% or 20% discount. So this is the standard terms in any price SHA or right. So basically, you are saying you are not taking a valuation report when you are issuing a CCPS.
Correct.
You are only finding MGT 14. Is
Correct.
it? Number 1, right? Number 2, so when you are converting it into equity, right, at the next round, so you are entitled to 20% discount of the price at which that other round happens.
That's right.
Right. At that time, you are taking a valuation report.
That's right.
Right. Suppose today the price is 100 rupees. The next round the price is, let's say, 150 rupees.
No, today price I don't know. Next round of price,
you
if
don't
it is
know,
100 rupees, 20% discount to that, 80 rupees.
So the valuation report which you will take at the second round, would that be of 100 rupees or 80 rupees?
It has to be 100 rupees. Because
100
it is
rupees. Okay.
Income tax also will trigger, right?
Okay, so that is 100 rupees. So you take a valuation report of 100 rupees, and then when you are filing pass 3, right, you will say that I have allotted share less than the fair value. Right. So you will tick that no box, right, saying that I have issued at a lower value.
Correct.
But I mean, I personally think, see, these ROCs and all these officers basically go by, the rule book. Once they see the checkbox, why they inserted these checkbox, like what is the, registration number and these things, they want to capture data. Right. And ultimately, when you take this no box, it might give them a red flag, and ultimately they will issue you a notice.
But see, you look at the practical situation, that.
But government does not go practical, na? I mean,
this is not a
the
new
law
thing,
is law.
that quite a few VCs are doing in this fashion.
No, but
Okay, they are practical.
sir, agree. But in view of the nowadays we are saying this ROCs, no, they are not practical. They're only a rule book. They're going line by line. Letterhead doesn't contain registered office word notice, SIN number, and ROCs become upload as somebody was telling. Income tax and GST, all the violations are only to the extent of taxes which is not paid, and also in ROCs this MCs become too rude. Any out of 458 sections, any section one rule is not specified. Form is not filed. This resolution number, section number is not mentioned. DIN number is not mentioned. SIN number is not mentioned. Yesterday, I think everybody was seeing this one. Considering the latest development, I think we need to relook at the past practices and also take care of the fixing the prices, sir. Yes,
So
sir.
this is a dangerous situation, I think. See, I mean, the authorities always see, in this country, private persons are always accountable.
Yes, sir.
Right.
Especially professionals, no.
Right.
Chartered accountants.
I just give you one example. Few days back we come across a government-owned company. There they have not complied with even independent directors clause. Right? It's a government-owned company, and independent directors are not appointed on the board. Will the ROC, levy a penalty on them?
Sir, we can discuss that. I think I can offline. I can connect.
Yeah.
Yes, sir.
Yes.
Can we conclude the session now? I request Mr. Shiv Prasad to formally convey vote of thanks for today's speaker on behalf of Bangalore Valuers Association.
Madam, before the Prasad, I'll take a minute. I thank BVA President, Vice President, member, MC members, all participants for patience hearing. I made my thoughts clear, so I also a lot of learned from the other senior members. Thanks for all participants for patient hearing. Thank you.
Good morning, dear friends. It is a great day for learning an interplay of valuation of securities under Companies Act, interplay with Income Tax and FEMA Acts. And the speaker, Mr. Chandrasekhar, a good friend of mine, has covered a wide range of topics like requirements of valuation, who is authorized to do the valuation, valuation under Companies Act, and valuation under SEBI regulations, valuation under FEMA, valuation under ABC, valuation under income tax, how to determine the fair market value, recent amendments to the valuation rules, tax implications to shareholders for rights issue, and valuation. Then he has quoted some examples also under different situations. He has also given the recent amendments which are the need of the day, so that we can be up to date with our knowledge. Then he has also covered how to determine the fair market value under the section 11 2A. Then the definition of securities, illustration. Then fight between say valuation of shares under the Income Tax Act and the Companies Act, and the tax implications under the transfer or gift of shares, And the NAV under the section 11 UA1 and 11 UA2. He has also kindled a lot of interest in among the participants, and many of the participants have actively participated in the discussions, clear their doubts, and thereby they have contributed a lot for improving the knowledge of all of us. And I feel that this subject needs one more session because of the complexity and the depth of the subject. I request Mr. Chandrasekhar to take another session which are not covered. Actually, from the slides, I observed that he has covered some more items like the case studies, then start evaluation, etc., the implications in start evaluation, etc. So, depending on the need and availability of Mr. Chandrasekhar, so I think we may plan for another session also in future.
Sure, sir.
And,
sure.
And I'm very much pleased to propose the vote of thanks to my good friend Chandrasekhar's program.
Thank you.
And I feel it is a privilege given to me by BVA. Thank you, Mr. Chandrasekhar, and all the participants for your active participation.
Thank you.
Mr. Chandrasekhar, we shall be forwarding this memento on courier to your address. Our admin will be in touch with you on this. Thank you, everyone. Have a wonderful, happy weekend.
Happy Navaratri.
Thank you. Thank you. Thank you very much.
Sir.
Vijay, you can stop the recording.
And also happy cricket today evening. That's there.
Yeah.
Ma'am, PPT, please.
Yes. Mr. Chandrasekhar.